Hi, it's Dreyer and welcome to another Wealth Insights. And in this specific Insights, I'd like to talk a little bit more about risk, how to manage your risk, how to take a calculated risk, what a calculated risk is, and then of course, how can we take action in order to be able to manage our risk. Now, the first thing that I want you to understand is that the system, the educational and the financial system wants us to believe that the higher the risk, the higher the growth. And on a financial point of view, that is absolutely not the truth. Because the moment that you're a wealth creator, you will know how to offset or mitigate risk. And we do that through competency. So the moment that you've got the competency, you can literally eliminate all the risk, or at least mitigate the risk down so that you can handle it. Now, your competency is going to determine what level of risk you're going to take. In other words, if you've got no investment competency or no business competency or no competencies when it comes to investments like property, then your risk will be extremely high. So let's go to the financial risk in terms of investment. The financial industry will tell you that the higher the risk, the higher the growth. But what they're not going to tell you is the reason why that is so. So, if I look at the formula for riches, the formula for riches basically says, is it possible? There are three questions. The first question, is it possible or legal to get to the outcome that I want? And that may be true. The second question that I'm going to ask is it possible to make this happen for me? And immediately it says, no, it's not going to be possible because I've got no control over the risk and I've got no control over the growth that I'm going to get on my investment. Now, why do I say that? Simply because the moment that I take my money that I worked for and I give it to someone else, I'm taking 100% all the risk, but I cannot control the risk, which is the third question. Is it possible? Can I make it happen? And do I have control over this? And the answer to that one is no, I can't control it, therefore I cannot make it happen. Plus, not only can't I control the risk, and I'm taking all the risk, but I also can't control the growth that I'm going to get on my investment. So because of that, because of the formula for riches, I know that I cannot invest in any investment that is promoted by the financial industries. For example, pension fund, provident funds, retirement annuities, unit trust, fixed deposits, the stock market in general and stuff like that. So I need to be able to handle the risk in terms of managing that risk. If I can't do that, I'm in I've got serious problems. Now, let's look and take one step further. Let's identify what the biggest risk is when it comes to investments or your business. Well, it's the ability to lose a capital. In other words, if I take money and I put it into that investment and the investment is not working, or the investment is not working the way that I want it to work, then that's going to be considered a risk. So the first risk is that ability to lose capital. So how can I mitigate risk, that specific risk, the investment risk? Well, if I want a certain outcome, and I know that at 10%, for example, I have to put in R1 million or dollars in order to get to the outcome that I want. The one way that I can manage the risk down is to put less money in. So if I know how to put in and use less money to get to the same outcome, it simply means that if I'm going to lose money, in other words, if the risk event happens, then the amount of money that I'm going to lose is smaller than if I put in a lot more money. So this simply means the only way that I'll be able to do that is through competency. In other words, I must have the skill, the experience, and the knowledge, the applied knowledge, in order to know, but how can I do that? So the ultimate of that, and that is what we as wealth creators do, and this is what we teach, is never to take any financial risk. So how do we do that? If I can start a business with absolutely no money, with no security, then there is absolutely no financial risk that I'm going to take. And this to a lot of people is extremely difficult to understand, because this is not how we are wired. We are wired that we have to take risk. And I'm telling you that that is not the case. If you've got the competency, and this is what we do, we coach and train and educate people that it is possible to start a business with no money. It is possible to even buy properties without any money. That is money from your pocket, right? By simply understanding how investments work and why we should do what we do. Because the moment that you start investing in property, as an example, there's a massive, massive risk if you don't know what it is that you're going to do, right? So another thing that I'd like to bring to the table today is simply the educational system and the financial system tells us that, when you fail, that is a risk. And that is absolutely a lie. Because a failure is not a risk. Failure is a learning curve. And we need to understand that, because the only way that we'll gain the competency, the knowledge, the skills, and the experience is to simply say, okay, but what is not working? What is working and what is not working? And if something is not working, it simply means that directly shows me that I still lack the competency to make it work. Because the moment that I know how to do something, I've got the competency, then it's not going to be a problem, and it can't be a failure. But to gain the experience and the applied knowledge, I have to actually go through the process to determine what is going to work and what is not going to work. Now, if you've got a structured process or a system that you can follow, you can eliminate 90 to 95% of all the risk before it actually happens. So you can speed up this learning curve without making these mistakes. Now, there's nothing wrong with that mistake, because that mistake, if you learn from it, can't be a mistake. It's part of the learning curve. So there's no such thing as failure. But there's definitely a way that we can speed it up through systems and following definite and certain processes. Okay, so now that we know that, let's go and take this more practical. And I'm just going to give you like an overview, or the way that I think you can go about. In fact, this is basically the basic outline. Of course, in the university, we're going to go 10 times deeper than this. But the basic outline that we need to understand is, first of all, you need to be able to identify the risk, right? What is that risk? And then you have to qualify that risk. For example, if I'm going to invest in properties, what are the major risks, right? And what is going to happen? So that's the first thing. And then with that goes, what's going to happen in the worst case scenario? So what are the worst case scenarios that can happen as an example with property? Well, first of all, the interest rate can go up. So if I buy at 10% interest and I've got a mortgage on it, and the interest rate goes up to the worst case scenario in South Africa, 25.5% on prime, will I be able to still manage that? So now we see that what we need to do with this risk, we need to take an educated risk. And this is a process that I'm following, or a quick process that I follow, in order to determine if this is going to be an educated risk, so that I can make an informed decision. So that's going to be the first thing. Can I handle that or offset that? Now, there are two ways that we can handle it. We can handle it by having the money available somewhere, or we can simply offset it by not taking on that risk at all. For example, if you buy cash, or you've got cash available, if the interest rate goes up but the property is paid in cash, there cannot be a risk, right? So that's one way. There's of course far better ways than that, but I'm just giving you a way. So the second thing that we do, that's one. The second risk is, but what if there's no tenant, right? If I'm renting a property out and there's no tenant, I'm taking a risk. The third thing that can happen is that I've got a tenant, but the tenant is not paying me, right? So by simply identifying the risk and then find ways in order to be able to manage it, then the moment that I can manage that risk, And in the likelihood of that thing happens, I've got a way to handle it. The risk starts to fall away. So if I can manage that risk, and it's an educated risk, there is basically no risk. And if it takes no money to get into the investment, and I can handle the worst case scenario of that specific investment, I've got no risk. Right. So Warren Buffett says the rule number one in investing, never lose capital, and rule number two, always follow rule number one. So here's a trick. What if I can find a way, and there's ways, where I can identify all the risk in the property and then find ways to manage all those variables so that in the event, the worst case event where everything happens, the interest rate goes to 25%, I've got no tenant on in the property, or the tenant is not paying me, what then? If I can still handle that, then as far as I'm concerned, and it has cost me no money, then there's no risk. Right, so that's the one way, actually it's a second step. We need to identify then what is the likelihood for that risk to happen, and what is a realistic outcome. In other words, what are the chances that it's going to happen, and in the worst case scenario, can I handle this or can't I? So if this does happen, if it happens, can I live with the outcome, yes or no? Now here's the trick. If I can't live with the outcome, with the knowledge and the experience and the competencies that I've got, then do not go into that investment. So the first thing that we look at is, can I handle the risk right now? But there's a second risk that no one talks about. If I need 10 million, as an example, in 10 years' time, but I've got only 1,000 Rand to invest in any type of investment, right? So I know that 10 years from now on, I must have 10 million. What are the chances and what's the risk for not getting it? So I know that if I need, let's say, 60% growth on my money, in order to be able to do that, it's not 60%, I'm just taking a figure out of my mind. Right, say for example that is 60%. So if it's 60%, but I'm getting 20%, it means I'll never be able to get to my goal. And that is an incredible risk. It's the lost opportunity cost of your investment. So we need to have a balance of these two risks. The one that I can handle now, this is the major risk, this is the biggest risk. But the second risk, equally important, but not as important to watch immediately, is the end result. In other words, I need to know my financial freedom growth rate. So just by knowing my financial freedom growth rate, in other words, how hard my money must work for me in that investment, I'm going to be able to eliminate 99% of all the investments that will not be able to give me that outcome. So just by doing that, I know, for example, if I need, again, 60%, but my investment that I'm going to invest, like in a unit trust or a stock, or is going to give me, or endowment policy or a retirement annuity is going to give me, let's say, what, 20%, but I need 60%. I know that I'm not going to go into that, and I'm not going to start that investment. Plus, immediately I know that I've got no control over the risk, because I'm taking the risk immediately. I'm also taking the long-term risk by not going to get my outcome, because no one over a 10-year period and no institution has ever given a 60% growth on a consistent basis. Right. So immediately, just by bringing that checks into place, I know that a conventional investment cannot and will not work. The risk is too high. I've got no control over the growth that I'm going to get, and therefore I break the formula, and therefore I'm not going to invest. Okay, so the next point is then, and I've already mentioned that, can I live with the outcome? If not, I do not invest. Right, so the next point that I'm going to do is, what are the benefits of not taking that risk? There are certain benefits to take the risk, right? And there are certain benefits not to take the risk. So if I know beforehand that I'm not going to get to my end goal, why on earth am I going to waste my time and energy to work for my money so that I can have the money to give to someone else that says that they're helping me when they're not helping me, right? So we need to identify the benefits of not taking that risk. That means I'm going to have peace of mind. I'm going to have a bigger amount of money available that I can use more productively when I've got the competency in order to be able to invest in whatever investment I'd like to do. And then also I need to identify the benefits of taking the risk. So on the one side, I need the benefits of not taking it. The second way, I need the benefits of taking that risk. If I know that I can lose no capital and that I can get to 60%, which is the goal, and that I can manage all the variables regarding that property or that business, and I know that I've got the competency to offset all the risk in the event of something happening, then it's a no-brainer. Of course, now suddenly I can take an informed decision. I know the negatives, I know the positives, I know how to handle the negatives, I know how to handle the positives, I know how to structure the deal simply because I've got the competency. And this is what I want you to do, exactly the same thing. So, in short, first of all, identify and qualify the risk, and then what is the worst case scenario, right? Secondly, identify the likelihood that this risk that you've identified that is going to happen in that specific investment or your business, and what is a realistic outcome. So in the event of averages, what's going to happen? This is exactly what we do with the property. We look at the last 10 years moving averages. We do a 5-year forward projection. And based on that projection, we say, okay, this is the realistic situation on the average that has happened over the last 10 years. And how can we handle the worst case scenario? So the third thing is then, if this does happen, in other words, in the event of the worst case scenarios, if it happens, can I still live with the outcome? If I can't live with that outcome, always the worst case scenario, I simply say, I'm not ready to invest. In other words, I do not have the competencies or I do not have the systems in order to be able to carry on with this investment. The fourth one is to identify the benefits of not taking that risk. So we need to know the positives as well as the negatives. And one of the positives is, if we do not enter this, I'm going to have a lot of more peace of mind. I'm going to have more surplus money available. Plus, I'm going to have more mental reserves available so that I can get to where I want to be at a certain time. And then the next simply is to identify all the benefits that I'm going to get by taking this. And the way that we do it as wealth creators, we simply say, we want to fall back on Warren Buffett's rule, and that is never to lose capital. Now, if I can make investment with no capital, and there's no risk involved, and there's ways that I can, those risks that do and can happen, like for example, higher interest rate, if I can handle that, and on average, I can still get in the worst case scenario to my goal, there's no risk. Right, and then once we've done this, now we make an informed decision for the first time, and we take informed action in terms of if I should go for it or if I should not go for it, and basically start looking at the alternatives. I think that is basically what I wanted to tell you today, because as a wealth creator, our motto is never to take financial risk. And this is what we do, and this is what we've learned. We learned the competency how to start a business with no money. Right? And then grow that business with no money, because there are two processes to a business. The first one is the startup process. The second process is, how do I grow this business by using the 5 basic profit drivers that we've got, but without costing me money. And then if I invest in a property as an example, how do we apply the formula for riches and the wealth creator strategies to mitigate the risk down so that there's actually no risk, but we are 100% certain that we're going to get to the outcome. So it is literally by combining the wealth creator strategy, the formula for riches, it is possible, if you've got the competency, to buy any investment, any class of investment, risk-free. And this is what I want for you. So I want you to gain that competency and put in the time and the effort in order to learn the competency, because the higher the competency, the lower the risk is going to become. And the lower the risk is going to become, the higher the growth is going to become. And it's the growth on your investment, taking risk into consideration, that's going to make you rich. So to become rich is actually a very, very simple, straightforward process, but we have to change our mindset from the normal way, the opportunity-seeking way, where we give our money to someone else, hoping that they're going to help us, and knowing that they're not going to give us the outcome that we want. To take full responsibility in order to learn the competency and go through the different levels, so that the higher the competency, the lower the risk is going to become, and therefore the more peace of mind we're going to have, and the higher the growth is. And if we achieve our financial freedom growth rate, which is the benchmark, then we invest. Otherwise, we know that we do not have the competency. We go back to the drawing board. We make sure that we understand the risk, and maybe at a later stage I can go into identifying the risk better, and also to show you perhaps how easy it is to offset some of those risks that you believe to be risk at the moment that are not supposed to be risk. And I think that is that for today. So I hope that you've learned, if anything. If you've got any comments, please give me and share those comments with me. If you do have questions, share the questions with us. If I've got time, I'll answer them. Well, I will answer them, but sometimes I do take that as an opportunity to shoot another little training video like this one. And thank you for being on this journey. I hope that you're going to accept this gift. I hope that you're going to look at immediately at all the investments. So identify all the investments that you've got. What is your financial freedom growth rate? Will they give you the outcome that you want? If not, and if you break the formula for riches, well, you have to take action, because that is part of the surplus, and it's only the growth on your surplus that is going to make you rich. So you have to protect that surplus, and you have to make sure that the surplus is working hard enough so that you never have to work over when you reach that certain point. Right, so thanks for your time. I hope that you enjoyed it. Give me feedback. If you think it can help other people, please spread the word, and I'll see you then in the next lesson.